Welcome, Jeff and Jack, to Wealth Matters podcast. How are you today?
Fantastic.
Yeah, doing great. Thanks for having us, Alpesh. This is
Uh,
awesome.
Of course, thank you. It was hard to get all of us on the same schedule, but thank you for
Right.
taking time out of your busy schedule on Friday.
Yeah,
Yeah,
no problem.
no problem at all.
My question to you guys, of course, I introduced you as the founders and the co-founder of Hydroton Realistic in Indy Market. Uh, of course. So, what do you do? What does that mean?
Shecky, let it rip.
Okay, we have a turnkey company, and we are full service. So we provide a complete end-to-end solution for typically mostly out of state and oftentimes out of the country investors. Obviously we're in Indianapolis because we've got all of our teams here, but that's the not the real reason. The real reason is because the price points here, and more importantly, the price to rent ratios are extremely attractive, probably some of the best in the world. And we've built a situation where we just go out and are able to put finished, rehabbed, warranted, performing tenanted properties in the hands of investors who don't really want to go through all that process, either because they don't have the expertise or they don't have the time. And we just provide that end solution for them.
That's awesome. So, how did you get started with real estate?
Jack, I'm going to let you take that one because there's such a long answer. The answer is not the same for both of us.
Right.
Yeah, about 4 years ago, Alpesh, my stock market, investments totally tanked. I was in oil and
Oh,
yeah, and natural gas, but natural gas was tied to oil, and for
of
whatever
course.
reason, and so they dropped like a rock. And
Yep.
I was playing the option game, so fortunately,
Me too.
yeah. Oh, really? Okay, cool. So,
Oh,
unfortunately, I had made some money in the options, so I'd reduced my risk in those particular stocks because I'd been collecting cash flow off those stocks for the last probably 24 months prior to that.
oh, okay.
But then when the stock market tanked, I mean, I pretty much lost all that those gains that I had made.
Right.
So obviously very frustrated and saying to myself, what the heck? Like, I don't want to live like this my entire life where my entire financial future is tied into the whimsical nature of the stock market.
Yep. Yep. And now that as I mentioned, I was doing options and futures and forex as well. It's so emotional, right? So your day totally depends on what you see on the screen, right?
Yes, right. So I'm the type of the way I've built my other nutrition company, like it's been slow and steady growth, 5-10% maybe growth a year,
Okay.
when you look at it over the course of the last 20 years. And now, I've got a monstrous business on that side. So I kind of looked at it myself as like an investor, although I'm not, I'm certainly an aggressive personality and I like to take risks and I like the excitement. I don't like big swings. And I
Right.
also don't like not being in control. So, at that point, I'm very frustrated and I'm saying to myself, okay, what's the lesson here that I'm supposed to learn? And how am I supposed to kind of redirect my future and the course that I'm on? And everything kind of just kept the little voice inside just kept saying, learn real estate, learn real estate. So that's what I did. I went and started, devouring books and podcasts, and
Yep.
for 100 days straight, I probably spent an hour a day just learning.
That's awesome.
And then after that point, I felt confident enough to start buying, although I still, didn't know what I didn't know, right? So
Right.
I did make, of course, some buying mistakes, but I think one great move was I bought into a turnkey property in Indianapolis, and the price to rent ratios there are incredible compared to most of the major markets throughout the
Right. Yep.
US. So I was getting great returns and everything was going awesome. And then I was sending in lots of referrals, and then I started getting rebates off my own kind of construction fees. And so I was getting into the properties at a lower price point. And then it turned into starting to get commissions. And then that's about right when I reached out to Shecky, who was my digital marketing partner in my nutrition company, and said, hey, like, I think there's a real serious business opportunity here, and I need your help and expertise. So I offered him a 50% equity in the Hydroton Realistic company. And then, that's where it all kind of started. And, I do have buy and hold property for myself. I really look at what we're doing in the turnkey space. It's more of a flipping profit. I look at that as a way to fund quicker my own buy and holds to create more passive income. So I think first and foremost, I am very much a passive income investor.
Yeah, and if you want me to answer the question, I'm ready to jump in now too. I started a long time ago, and I was doing a lot of house hacking back even as late as the late 1980s, before that term house hacking became popular. And I obviously at that point really understood some of the power of what you could do with real estate. And over the years, I was always intrigued by it and had been to a few seminars. But in the early 2000s, I started a flipping business with a buddy of mine down in Texas. And we did fine for 3, 4, 5 years. And then, of course, we all know what happened in 2008. And that's when basically got completely wiped out. And I swore off real estate and said, I'm never doing this again. And I this was at the time, 08, 09, with the internet was a lot different than what it is now. But I was very, very intrigued by, the possibility of growth with the internet and what you could do from a marketing standpoint. So I kind of did what Jack did with real estate. I started just studying internet marketing. And I actually moved from San Antonio to Austin to be closer to a then growing digital marketing community. A lot of really cool entrepreneurs lived there, and they were really pushing the envelope on what was possible in the online marketing space. And I learned quite a bit. And, long story even longer, I ended up working with a buddy of mine who owned a social media company, and I was running his consulting division. And Jack happened to be one of my favorite clients. And so, as he mentioned, that's kind of how things started. And, initially I was like, yeah, I don't know, real estate. I mean, I want to hear about it. But I originally went into that conversation really just looking to help out somebody that I respected. I was not looking at it from a standpoint of going into business. But once we really took a look at this and saw really the opportunity, and the opportunity really wasn't just for us, but I believe that any good business is there because there is a hungry market that really wants what you had. And knowing that, Jack had some success and some not so good success, and had spoken with a lot of other investors that, they liked the concept of turnkey. It really made a lot of sense because they were busy and didn't have the expertise in rehabbing or even in placing tenants. There was definitely a hungry market for it, but there were very few in the space that were really doing it right. And most of them were what I affectionately call bottom feeders. They just were, slap a property together and, if you can talk an investor into taking it over and getting it off your hands, and then you wash your hands of it, that was really the way a lot of the market was operating. And
I could throw names out there, but the one name which is on my mind is Clayton Morris.
Yeah. Yeah, and there's some great individual players and some bad individual players, but we just didn't at the time. We didn't see that there was anybody really doing it the way it should be done. There were one or two, and they were bigger companies, and they had been at it a long time, but they didn't have very, very good returns. And so we said, probably, there's got to be a way in a town like Indianapolis, where we've got such great pricing and such great price to rent ratios, where we could do both. We could provide some really good customer service and really be good guys to work with, and also be able to give the investor high returns. So that's what we really set out to do, and that's really what we work on every single day.
Perfect. Thank you for the intro. We'll take a break and we'll be back after the break. So we are chatting with Jeff and Jack from Hydroton Realistic. Thank you for that intro. I want to ask why Indianapolis market? I know you mentioned about price to rent ratio, but what else is going on for the Indy market? I know a lot of people mention all the time that, oh yeah, I want to invest there, or I'm investing there. But what are some of the things going for Indy market?
So I'll start, and then Shecky actually moved from Austin to Indy, so he's going to give you probably a little more detail than what I can. So I'll give the broader view. I was hit with this saying that really that's what turned me on to investing, out of state and buying turnkey originally myself, right? So live where you want to live, but invest where it makes sense.
Exactly. I live in California and I don't invest here at all.
Yeah,
of course I can't.
Right. Doesn't make sense, right?
Yeah.
So I was having trouble finding enough properties to really scale a portfolio. I mean, I could find 1, 2, 3 offs here in my town here in Southwest Michigan, but nothing to really, really scale. And the market here is very competitive with the Chicago money coming in. So I had to go out of state. So I started analyzing the different markets around the U.S. And, obviously we know that the coastal markets are way overinflated in potentially bubble type prices at this point.
Oh yeah, for sure.
Where the, even if you rent out the property, I mean, it's going to be even very difficult to positive cash flow it at all, let alone to get a decent return on your money.
Barely break even.
Yeah, right. Exactly. Yeah, right. And that's why take the risk, of that when you're barely going to break even, unless you're just so confident, right, that the appreciation is going to happen, which again,
if you want to gamble like that, then just stay with the stock market.
Right?
Why even do real estate?
Yeah, I'm aligned with that. So what's great about some of these Midwestern, kind of bringing it into more a regional view and then an Indianapolis view, the Midwestern markets, they're very stable. Like they haven't gone up a whole lot since 2008, and they didn't drop a whole lot in 2008 either. I mean, they had their correction, but it wasn't so severe as what you saw in most of the other markets around the country. So now you're looking at dialing into Indy. You've got an extremely kind of stable market in terms of jobs. There's a wide diversification of the type of jobs that are here. Like if you contrast it to Detroit, which I know Detroit has some good turnkey going on right now, but what kind of would make me nervous about investing there is that it's so hyper dependent upon the auto industry. So the auto industry is great. It's going to be great there, but when it's not good, really, really bad, right?
So that's the problem with one trick pony, right? When this town is dependent on one type or one specific, industry, right?
Yeah, exactly. And Indianapolis being kind of like in the center of the country, it's got a major logistical hub. So there's so many jobs in logistics, transportation. It's got lots of still manufacturing and blue collar jobs, and it's just a very, very diversified economy. So the jobs are very stable. And that creates then a stability in the pricing of properties. So we can we can find properties where we can turn them over to the investor for single families in the C class for 45 to 70,000 range, depending on, C to B class or, single or duplex. But most of the properties that we sell are typically right around in that price range. And for those that are on the coastal markets, it's baffling to them how we're able to provide, a product at that kind of price. But those are, we're putting together a nice quality product, and for the investor that cash flows nicely, and we're still able to be profitable. It's a total win-win. So Shecky, anyways, that's my view. I mean, you've got to probably even more dialed in, you having lived there.
Well, I think there's other things that are, you bring up a good point, Jack, about the Midwest in general. And, but one of the things that we really liked, or many things we liked about Indiana in particular over other parts of the Midwest, is some very favorable conditions for investors. And what I mean by that, let's start with landlord laws. So this is a state where if you have a tenant that is not paying or is in breach of lease for any means at all, from the time that you discover this breach until the time that you can actually have your tenant out of your property can be 30 days or sometimes even less if you get lucky.
That's good.
Yeah, so laws are very supportive of that. The other thing that we see here is that partially because the property values are inexpensive, the tax rates are also very attractive too. So in some states, we might see 2.5%, 3%, 4%, 5% for property tax. In Indiana, it's capped. If you're a non-resident owner, it's capped at 2% of the assessed value. And in Indiana, obviously, our assessments are happening in arrears, which is very unusual. And we've also got, lower values in general. So most of the properties, the assessment's lower than the actual value. So we see dirt cheap prices on property taxes every year. And then also as a result of those assessments being low, the properties themselves become very, very inexpensive to insure. So property and casualty insurance, which is again just a regular expense of owning an investment property, is also lower. So, and like Jack mentioned, we've got a wide variety of bigger employers here, and there's a lot of good smaller business and entrepreneurship here. I mean, Indianapolis is a big city. I think that the metro area is well over 2 million now, and
oh wow.
But it's very, very spread out. It doesn't feel crowded. So we have, all the amenities of a big city with not nearly as many of the problems. And so, my only real beef about Indy is the weather. Obviously, after moving here from Texas, but
yeah.
so I tend to like things a little bit warmer. But if you like Four Seasons, man, it's a great place, and there's some really great big tech companies that are, moving a lot of their teams here because look, you could pay somebody $60,000, $70,000, $80,000 a year in Indy, and they can live like a king. And I'll pass 60, 70, 80K where you live. They're eating out of a can of beans.
Yeah. You are homeless.
Yeah, you're homeless at that number, right? And here you're living well.
Yeah.
So there's just a lot of conditions that are favorable even to Indianapolis and Indiana that would outweigh other choices in the Midwest.
Well, that's a really good summary about the Indy market. Thank you both. So I remember we discussed about the process, but what kind of process do you have in acquiring and rehabbing these properties, as well as putting the tenants in those properties? How do you differentiate yourself from, let's say, some other turnkey provider, or what have you done to tighten or streamline this process?
Well, I don't mind taking that one. So we have really, we weren't really planning this, Alpesh, but like when we originally got started, we were using another supplier, and
okay.
Jack and I joke around. We thought we were just going to be a sales and marketing company. Bought a few results, but anyway, everything broke, and we realized that we couldn't rely on anybody else other than ourselves to provide the kind of quality and the kind of experience that we wanted to have as investors, and that we wanted our investors to share. So we went through and retooled everything, and we started acquiring all of our own properties. So we, went out and developed all the relationships with wholesalers and hedge funds and all that other kind of stuff. And, now we've got a gentleman that does all of that for us. And, but we only look for properties that pretty much are more in what we would call center township in Indianapolis. They're 5 to 20 minutes from downtown. So there are always properties that are in high demand. We make no bones that we pretty much stick to C class. So they're not necessarily the Taj Mahal in any way, but
Right.
it's good, solid, rental properties for working class individuals. Typically our tenant base is not necessarily white collar, they're more blue collar. And that's just the price points that we stay with work really, really well. But we've developed we found that obviously the quality of the property, I'm not talking about how pretty it is, I'm talking about the quality of the rehab, has everything to do with how well a property performs. So when we actually acquire a property, we have a third-party inspector come in before we even start the rehab. Now, for the listeners, you're probably scratching your head at this point going, why the heck would they do something like that? Well, we do that because we actually then don't have to rely on any other contractor or any of our own team members to decide what a property really needs. So we look at that as a very inexpensive employee who is doing quality control and who is helping us develop a proper scope of repairs for that property.
Yeah, and that person is more of neutral, right? Third party. So that's also
giving you completely neutral.
Another set of eyes, right?
Yeah, another set of eyes, completely neutral, completely impartial. So then we actually have a 41-point checklist that we've developed, and we use both internal teams and some external teams that we have developed some really great trusting relationships with that treat us right on volume pricing. And we then go ahead and say, okay, we're going to do all of our safety checks. We're going to do all these things. We check everything. We check plumbing, electric, all the mechanicals. We replace things in certain conditions automatically or at certain age automatically. But we have 41 things that we go through and look at. When we get all done with that, we actually call the inspection company to come back and not do a refresh, but to actually do a full, complete, third-party, impartial inspection again. Start over from the beginning. Again, we want an impartial view of how that rehab turned out. So that, again, is done for a couple reasons. One is we issue a warranty on our product. So any investor walking in is going to get what we call a roofed foundation warranty, where we're guaranteeing the operation of the major operating systems of that property. So one of the things we want to make sure that we do is that we're not hanging ourselves out on a line by putting out a property that might need warranty work. We want to make sure that there's a high likelihood that it doesn't. Secondly, we learned from our own mistakes previously of placing a little too much trust in others and too much trust in systems that weren't complete, that we want to provide transparency to the investor. We want the investor to say, hey, look, this is the actual third-party, verification condition of what this property condition is like right now, so that when you're buying a property from us, notwithstanding our warranty, but for many years to come, you have something that's going to be a solid performer. And then, of course, we've developed our own complete property management team as well. So we go through and we go through our screening process. We market for tenants. We place a tenant. If we even missed anything on the inspection, we'll come back and have our team dial back around and cure any of the items that might have been remaining on that second inspection. So I'm not here to tell you that it's perfect. We still make mistakes, and there's still things that might even get missed, even with all those stopgap measures in place. But when the investor buys a property, they're now buying a property that was sourced correctly, it was rehabbed correctly, it's warranted, a proper tenant was placed in there, the tenant is being managed professionally, and it's currently performing and cash flowing. And when we show investors those numbers, we are not adding any fluff. So when you look at the data sheets, what we call CFO cash flow opportunity on our website for each property, that's a reflection of how the property is performing right now. So it's got the insurance quote that we've gotten, we've researched the taxes, we know exactly, not exactly, but within a point or so, of what the vacancy rate is going to be on that property based on our previous experience. And so everything is on there. There's nothing, we've basically lifted up the dress so that when the investor looks at it, they know exactly what they're getting. And it becomes very, very easy for them to make a decision on whether that's something they want to add to their portfolio or not.
That's awesome, especially the warranty part. I was surprised that I haven't seen that pretty much anywhere else. So that's great.
Well, Apesh, what we found, is when a tenant moves into a property, they start, really finding out what the rehab was made of, what the property was made of. Right?
Yeah, that's when they start beating on it. Yeah.
Yeah. So that's when the most, the things are going to come up. And what we found is we were paying for those anyways, whether we offered a warranty or didn't offer a warranty, just to provide goodwill and keep a long-term relationship with our investors. Because at the end of the day, we're not in a transaction type company. We're a long-term relationship type company. Yes. That's how we approach this. So we just said, you know what, it'll probably make the sales process smoother and easier and give the buyer, the investor, more confidence if we just give them the warranty up front in writing and we all sign it at the closing table. So that has kind of gives them peace of mind.
Exactly.
And we've really definitely enjoyed being able to provide that as well. And then I just want to throw in one other thing as far as what Shecky said. On the third-party inspections, sometimes we get investors that ask us to order another one. They're like, well, are you in cahoots with this inspection company, right? So that's certainly, it's a great question. And so what we tell them, and there's a hard line in the sand, is we say no. So here's how we look at it. So the company that we use, they're very well known, very large company. They're an independent of us, and they are there to police us, not to protect us. In other words, we want them to show us everything that's wrong with the property, because at the end of the day, it's going to cost us if they don't. We're going to have to pay that out, that money back out in warranty claims. So if it's not done right. So we want it done right, and we need it done right. And it's so much smoother when the third-party inspections are coming in during, before, and then the end of the rehab process versus, we've got this property with a tenant in place, and now they just moved in, and now a week or two later, or 3 weeks, or whatever the case, investors ordering another inspection, disrupting their life. It just didn't work. So we just say, everything that we're providing, we are so transparent. We show scope of work, we show full set of pictures, we show 2 inspection reports. If that's not enough, along with the trust and goodwill that we feel that we've, put forth, with all of our investors, then we're probably not the ones for you. So then let's just, let's go somewhere else. You guys go somewhere else and we'll find somebody else to buy this. So that's how we look at it.
I see. No, which makes sense. So I know Shaki mentioned about rent to price ratio. So can you tell me what kind of price point are these properties in, and what kind of rents do you see?
Yeah, so we deal mostly in single family homes. We do get the occasional duplex every once in a while. We've moved away from a lot of the other smaller multifamily just because it's difficult to work with some of those tenants and get them to perform as well as they work on paper. So we stick mostly to single family homes, and in that price point, we're looking typically at about a $45,000 to $70,000 price point. Rents in that range will go anywhere from about $600 to $875, let's just say $900 maybe. So when you do the math, easily hitting the 1% rule, most times approaching the 2% rule, although it's not really a rule. But we are very proud of the fact that after, and I had mentioned this before, after putting all the expenses on our cash flow opportunity sheets, in almost every case, except, there are some exceptions, we are able to get the investor double-digit returns on just about any property that they buy from us. And when I say double-digit, I'm just talking strictly about cash on cash. And certainly we have a percentage of investors that'll dial back around and do a cash out refi and things like that, and that will probably improve their cash on cash position. But I'm just saying, if it were not financed at all and they just stuck with a straight cash purchase, then those are some really, really strong numbers.
So that's amazing numbers actually right now in this market. So one more question I have regarding, because you brought up financing, are this because if I remember correctly, it's hard to get financing for a property sub 50 grand. So how do you sell these properties, on cash, or do you also have lenders you work with, or how does that work?
No, we're all cash. That doesn't mean that to the investor it's necessarily they're just writing a check or sending a wire, because some of the investors will do a 1031 exchange. Some of them will do out of a self-directed IRA. Some will do the infinite banking thing. There's lots of ways.
Private money lending.
Sure. So there's lots of ways for the investor to generate the funds for the purchase, but when we actually go do the transaction they're buying from us, we're receiving all cash. And the reason being, there's a couple reasons for it. Number one is, you mentioned it, is that in the $45,000 to $75,000 price points, most lenders have $75,000 minimum. Yeah. So these properties do not lend themselves, pun intended, to upfront financing. They just don't. Right. And we found that earlier in the history of our company, when we tried to allow for financing, we were writing up all kinds of deals, but they were never closing. And it's like, right. We're not in business to do paperwork, it's just, and so we just had to kind of, like, to use Jack's words, draw a line in the sand and just say, hey, look, this is the way we do it. And interestingly, our business went up by 5x in the next 2-3 months after we did that, because we very clearly just said, hey, look, we're only dealing with investors that want to operate in this way. And the other thing that allows us to do, which is probably more important than the first point, is it allows us to close quickly, thereby getting properties to market faster. We do our thing. We don't let another inspection come in to gum up the works. We get them tenanted, we get them cash flowing quickly, and we get them off our plate. So the shorter period of time that we're holding on to these properties, the less our holding costs are, and the less we can actually charge the investor for that property, which obviously helps his or her ROI. So we're doing everything that we can to keep our prices down, and selling all cash is a really big way that we do that.
Yeah, we can't hold a property for 3 months waiting for a bank to, do all their whatever it is that they do, and tie up a property when it could have been sold, within. Sometimes we sell them within three days and close them and fund them by the investor. By the time we even get it done and ready and present it to an investor, we have had turnaround times that quick. So if we were, we don't have a infinite amount of inventory either. It takes a lot, as you can imagine, to get a property all the way through to the finish line and get it cash flow producing. So when we get something to the finish line, typically, honestly, they sell within about 24 hours. So we usually have a purchase agreement, and they're off to the title company.
That's awesome. So, and I want to remind my listeners that, of course, as you mentioned, they can do cash out refinance, as well as do not forget about portfolio lenders, right? So let's say you acquire a couple of properties in Indy or more, you can go to a portfolio lender and combine all of them into one as well. So there are other ways to, get your cash out after you have acquired the property, as well as that will give you bigger cash COCR or cash on cash return.
We've had a lot of investors that have done a cash out refi successfully, and it has worked. So it's not that we're investors ourselves. We're long-term buy and hold investors. So, I'm very much aligned with wanting to use leverage. I understand how it magnifies your returns, most of the time by at least double. So sometimes more, right? Depending on how much leverage percentage that you use.
Right.
So we're very much for it. We want our investors to do it. Of course, they can then buy more. They're just doing it on the back end versus doing it on the front end with us.
Got it. No, this was great. I appreciate taking time out of your busy schedule. We are at the end. How can my listeners reach out to you?
Well, everything. Oh, go ahead.
Yeah,
Go ahead.
I mean, it's everything is on our website, hydrotonrealistic.com. We also have the High Return Real Estate Show podcast. They can subscribe to it right there. They can learn more about, see potential properties. They can book a call with our head of investor relations, Nicole. She is phenomenal. Everybody loves her and her personality and her knowledge. She actually was one of my very first investors. And she still is today a buy and hold investor with us. So she really has that, unique perspective that a lot of our investors, they really like working with her for all those reasons. So that's what we'd suggest if they want to kind of learn more. We actually don't sell a property until somebody books a call with Nicole and actually goes through that process. Just simply, we want to make sure that it's a good fit and that what we offer and what their goals are is going to be a good long-term partnership.
Right.
And sometimes it isn't, sometimes we don't match up, and that's fine too. But we want to know that, going in, because we look at it as really we're in partnership with our investors. It's not a transaction.
Yep. Yeah. You want to build a long-term relationship, right?
Absolutely.
Everyone, real estate is, networking and long-term business, right? So
Yeah.
Awesome. Thanks again. Thank you both, and have a nice weekend.
Yeah,
Thanks so much.
Appreciate you having us on the show. This was really fun.
Of course.